Pakistan, officially the Islamic Republic of Pakistan, is a low-income developing country in South Asia. Although is the world's fifth most populous country and third largest in South Asia with a population of almost 243 million people, it ranks 23 RD largest in terms of GDP based on purchasing power, fitting poorly in development indicators set by the World Bank, and has since been left behind by most countries in South Asia. Over the past decades, Pakistan has been in a tight spot over its economy. Amidst very high inflation and extremely low forex reserves, the country has made the news for being denied further funds from the International Monetary Fund, an important development in international affairs. However, the country was not left without measures to aid its recovery. In fact, the IMF supplied some unsolicited financial recovery coaching to Pakistan, which included increasing tax rates and reducing subsidies. As Pakistan's economic crisis worsened, the country's prime minister claimed that the government would have to accept the IMF bailout requirements. But contrary to that claim, mostly for fear of negative reaction and rejection before the upcoming elections in October 2023, the Pakistani administration has refused to implement the tax increases and subsidy reductions as advised by the IMF. The Pakistani economy is currently in an unpleasant state. You might be wondering to what extent this is. Let's take a look at some of the things that are going wrong. The most notably economic crisis plaguing the country is high inflation. In 2022, Pakistan experienced a high inflation of about 24.5%. As incredible as that sounds, the percentage was about 29% higher in rural Pakistan, leaving the international community to wonder at the state of the rural dwellers. Another unenviable economic situation Pakistan faces is high indebtedness. Pakistan's financial crisis is not a recent occurrence. In fact, the country has long struggled with a number of issues, causing it to be heavily indebted to friendly countries and the International Monetary Fund. For years, Pakistan had been on the Financial Action Task Force Grey List as a result of strategic counter-terrorist financing-related deficiencies. This was at a time when Pakistan's credibility on the global stage was dwindling because of its precarious economic situation. As a tackling strategy, FATF, the global money laundering and financing watchdog, placed Pakistan on a 27-point action agenda, which was later increased to 34 points, related to money laundering, terrorist financing, and action against armed groups and individuals. Being on the list of countries under increased monitoring had an impact on Pakistan's global standing and led to the imposition of several economic sanctions, including severe restrictions on the country's international borrowing capacity. This didn't happen for long as Pakistan was finally taken off the Financial Action Task Force Grey List in 2022, after being on it for many years. The economy was beginning to take shape until the food crisis hit the state. The cost of perishable foods in Pakistan increased by over 56%. Terrorism is another rising issue in the country. In an effort to split Pakistan into two countries, Tehreek-e-Taliban Pakistan has increased its terrorist activities in the country since 2022. How did Pakistan get to such a low point? The crisis has been fueled by political turmoil and external shocks from the global commodity crunch. Typically, a third of Pakistan's import payments relate to energy. In the last financial year, petroleum group imports, including LNG, more than doubled from a year earlier, according to the Statistics Bureau. Most of its electricity is produced using LNG, prices of which remain elevated and which will be in shorter supply with the winter approaching. Higher energy bills propelled Pakistan's current account deficit to over $17 billion in the last financial year, which is 6 times higher than 2020-21, despite record-high remittances from abroad. An overheating economy also contributed to the widening deficit. Imports rose 42% to a record $80 billion in the last financial year. Exports also hit a record of nearly $32 billion but grew 25%. Currently, Pakistan is facing a serious financial crisis as its government rushes to tackle the situation with drastic measures. What are the factors that have pushed the country towards such economic disaster? The first is the 2022 floods. Pakistan was hit by major floods towards the end of 2022 that killed over 1,500 people, cost the nation billions of dollars in damages, destroyed essential infrastructure, displaced about 8 million people, and reduced domestic output, heaping even more pressure on its finances. Before the floods hit, external financing needs for the 2022 to 23 financial year were estimated at $33.5 billion, according to the country's central bank. This figure was to be met on a challenging target of almost halving the current account deficit and debt rollovers from friendly countries. However, the floods changed the projections. Exports are expected to slump and imports to grow to make up for essential commodities lost in the flooding of millions of hectares of farmland. Another factor responsible for the crisis in Pakistan is the inconsistent and pro-cyclical economy. The current economic crisis is primarily attributed to Pakistan's short-sighted policy decision, leading to extensive spending on non-developmental and economically unviable projects. Economic mismanagement and financing of futile infrastructure projects like Gwadar-Kashgar railway line project through long-term debt and relying massively on external borrowing rather than from domestic institutions added to its troubles. Rollout of the China-Pakistan economic corridor increased the debt burden, opening the doors of ever-increasing external loans. Notably, CPEC created a Chinese debt of $64 billion on Pakistan, which was originally valued at $47 billion in 2014. The persistent fall in the Pakistani rupee against the US dollar has further contributed to the ballooning external debt. Falling confidence coupled with low ranking by international rating agencies and gray listing of Pakistan in the Financial Action Task Force kept foreign investors away. The State Bank of Pakistan data suggests that in the past 10 years, foreign direct investment inflows into Pakistan never exceeded 1% of GDP. The vicious cycle of seeking fresh loans and repaying old ones has led Pakistan into the notorious debt trap they are currently in. Moreover, due to the reluctance of the international community in extending loans to Pakistan, the country was forced to resort mainly to China and Saudi Arabia, and thus making it vulnerable to their complex terms. Also, a widening trade deficit and falling investment has led to a sharp fall in the foreign exchange reserves in Pakistan. The foreign exchange reserves fell by 1.97% in the second week of November to over $23 billion compared to $24 billion in its previous week in 2022. The reserves of commercial banks also declined to about $6 billion from $6 billion in November 2021. The depreciation of the Pakistani rupee against the US dollar reduced the value of the existing reserves. It is important to note that inflation in Pakistan touched its highest level in November 2021. This is primarily because of the global rise in crude oil prices, leading to costlier freight charges. As it is, Pakistan is a net importer of essential food items such as pulses, wheat, edible oil, and sugar. Notably, Pakistan's food imports consist of around 16% of its gross imports, which is why it is rather devastating that the country has been affected by the global rise in the food prices. There is no doubt that the sharp increase in the energy prices during the last few years have created immense inflationary pressure and burdened the common citizen with additional expenditure. Now, the big question is, what can be done to save Pakistan from total ruin? What are Pakistan's options? Immediate solutions would have financing and compressing demand for imports. But since the floods, it has been impossible. Also, with investors demanding a 26% point premium to hold Pakistan's international bonds over safe haven U.S. treasuries, Pakistan is locked out of international capital markets. However, the government says it expects increased financing from other multilateral lenders. Saudi Arabia, United Arab Emirates, and Qatar had pledged some $5 billion in investments. That would boost both finances and confidence. Energy payment facilities from Riyadh and Doha, from whom Pakistan buys liquefied natural gas, will also ease pressure on the country's current account. Also, Pakistan is talking to bilateral debt holders, including the Paris Club, to restructure payments. But China is the key, holding nearly $30 billion of Pakistan's debt, including loans by its state-owned banks. The tunnel seems bright at the other end, especially knowing that Pakistan has never defaulted on external debt obligations in the past. Also, the country's central bank and finance minister have stressed that it was not facing imminent default. Pakistan's economic crisis continues to worsen as the country struggles to cope with mounting debt, inflated energy import costs, dwindling forex reserves, global inflation, political instability, and a sustained drop in GDP growth. For the government, it is now a race against time to prevent the nation from a complete economic collapse, which could severely impact millions of citizens.